Tax-advantaged accounts are special investment accounts that the government provides tax benefits for. These accounts help you save money on taxes while building wealth for your future. Whether you're saving for retirement or medical expenses, these accounts can significantly accelerate your wealth-building journey by reducing or eliminating taxes on your investments. There are 3 primary types of tax-advantaged accounts you should know about. First is the 401k, which is typically offered through your employer. Second is the IRA, or Individual Retirement Account, which you can open independently. Third is the HSA, or Health Savings Account, designed specifically for medical expenses. Each of these accounts offers unique tax advantages that can help you save thousands of dollars over your lifetime. The 401k is an employer-sponsored retirement account. When you contribute to a 401k, your contributions are taken from your paycheck before taxes are calculated, which reduces your taxable income for the year. Many employers offer matching contributions, meaning they'll add free money to your account based on how much you contribute. Your investments grow tax-deferred, meaning you won't pay taxes on the growth until you withdraw the money in retirement. Individual retirement accounts come in 2 main varieties. The traditional IRA allows you to make tax-deductible contributions, reducing your current taxable income, but you'll pay taxes when you withdraw the money in retirement. The Roth IRA works differently. You contribute money that's already been taxed, but all your withdrawals in retirement are completely tax-free. Choosing between them depends on whether you want tax savings now or tax-free income later. The Health Savings Account offers what many experts call the triple tax advantage. First, your contributions are tax-deductible, reducing your current taxable income. Second, your investments grow completely tax-free. Third, when you withdraw money for qualified medical expenses, those withdrawals are also tax-free. To qualify for an HSA, you must have a high-deductible health plan. Unlike flexible spending accounts, HSA funds roll over year after year, so you never lose your money. The government sets annual limits on how much you can contribute to each account type. For 401k plans, you can contribute up to $23,000 per year. For IRA accounts, whether traditional or Roth, the limit is $7,000 annually. For health savings accounts, individuals can contribute up to $4,150 per year. These limits are for individual contributions and may be higher if you're over age 50 or have family coverage for HSAs. Tax-advantaged accounts provide several powerful benefits. They reduce your current taxable income, meaning you pay less in taxes today. Your investments grow either tax-free or tax-deferred, allowing compound growth without the drag of annual taxes. This helps you build long-term wealth much more efficiently than taxable accounts. Most importantly, these accounts help you secure your financial future by making retirement savings and healthcare more affordable through strategic tax planning. Now that you understand the 3 main types of tax-advantaged accounts, it's time to take action. Start by determining which accounts are available to you based on your employment and health insurance situation. Consider your current tax situation and retirement goals when choosing between traditional and Roth options. Even small contributions to these accounts can grow significantly over time thanks to tax advantages and compound growth. The sooner you start, the more you'll benefit from these powerful wealth-building tools.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.